Chapter 5 deals with inventory or merchandising for a business. The first 4 chapters that we have covered have dealt with service businesses where inventory is not a factor. A company simply sells services, not a product. Chapter 5 handles the accounting for inventory. And as we'll see in the following slides, it's quite a bit different than the accounting for a service business. Of course, the biggest difference is in a service business, we sell a service. In a merchandising business, we sell a product. Because we sell a product, we have to deal with merchandise inventory. So basically, a business would buy inventory, perhaps warehouse it, and then they would sell it. We would handle the sale the same way as we did as if it were a service business. However, we have one additional element. We have to record the cost of the sale. In other words, the cost of the merchandise that we purchased and now sold. To that end, with respect to accounting for merchandise, we have 2 systems that we can use. One's called the perpetual system, inventory system, and the second's called periodic. Difference between the two: in the perpetual system, as we receive inventory, we record it. As we sell inventory, we record it. In other words, on a perpetual basis. In the periodic inventory method, we only count our inventory and record the sale of our inventory at the end of an accounting period. This, of course, would require a physical inventory. So the recording of a business transaction using inventory would be, number 1, record the sale, typically debit accounts receivable, credit sales, just like we've been doing all along. However, this time we have to relieve the inventory from our system in the perpetual method. So we would debit cost of goods sold. That would be an account, a general ledger account, and we would credit inventory. Chapter 5 also introduces the multi-step income statement, where we'll now record sales. We'll have to record our cost of merchandise sold, which is essentially a special type of expense. Difference between the two would be gross profit. Then we'll record all of our operating expenses. That leads to income from operations. We'll record other income such as interest income and other expense such as interest expense. And finally, we arrive at net income.